US consumer confidence slumps, but markets are firm, hopeful the Fed can cut. But that may be a while off yet. Asian markets will watch key economic data from China today, and ANZ Research has lifted its New Zealand inflation forecast a bit in the short term. That's coming up in our 5 Things in 5 Minutes on Monday, May the 19th. And then, in our deep dive interview, ANZ's head of FX research, Mahjabeen Zaman, takes a closer look at Moody's downgrade of the US sovereign credit rating on Friday due to high and fast-growing US government debt.
If the Tax Cuts and Jobs Act, the TCJA, is extended, it will probably add another $4 trillion or so to the fiscal deficit over the next decade.
But first, in 5 and 5 with ANZ, US consumer confidence has slumped, according to the University of Michigan Sentiment Index report on Friday. It fell 1.4 points to 50.8 in May, its second lowest level on record. The survey was taken between the 22nd of April and the 13th of May, which means it covered only 2 days after both US and China agreed to reduce tariffs on each other, temporarily, by 115 percentage points, says ANZ economist Bansi Madhavani.
In the latter stages of the survey, there was an uptick in sentiment following this tariff relief, but not enough to halt the decline. More stark were the inflation expectations results. The one-year inflation expectation surged to 7.3%, its highest since 1981. The medium term, which is the 5 to 10-year inflation expectations, those rose 4.6%, which is its highest since 1991. So the Fed will be concerned about any potential unanchoring of inflation expectations.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up 0.2%. The Aussie and the Kiwi were both flat, with the Aussie at 64.03 US cents and the Kiwi at 58.82 US cents. The Nasdaq closed up 0.5% on Friday, while the S&P 500 ended the week up 0.7%. The US 10-year Treasury yield rose 1 basis point to 4.44%, and gold fell 1.2% to $3,187 US an ounce. West Texas Intermediate oil futures begin the week up 1.4% at $61.90 US a barrel. Number 2. Bansi says the Fed is likely to remain on hold for now, despite an easing of some of the fears about tariffs.
So despite this de-escalation and tariff-related concerns, we think the FOMC is likely to remain patient. Our expectation is that the FOMC is unlikely to cut interest rates anytime soon, and we forecast the first rate cut to be in third quarter, potentially by the Fed's September meeting.
Number 3. The focus in Asian trade today will be on Chinese economic data for April, says ANZ's chief economist for Greater China, Raymond Yung.
Our expectation is for the retail sales to stay strong at 5.8% increase. I think compared with last year average, this is already considered a strong number. And industrial production will also be very, very strong with a very solid 6.5%. And that would probably benefit from some of the front-loading activity by exporter. The downside of the data release, we expect is property investment still be a negative number of close to 10%. The property market has not been seeing a significant rebound.
Number 4. Raymond says the current pause in higher tariffs between the US and China does increase the chances that China's GDP will do better than his current forecast for 4.2% growth this year. But it's still too early to formally raise the forecast.
Given the fact that both sides, the US and China, has already lowered the tariff, and we expect exports and the factories' activities will still be very solid in the second quarter, and that's definitely brings some upside risk to our current GDP forecast of 4.2%. Now, of course, we still see a lot of uncertainty because this is only a ceasefire. Definitely not the end of the trade war. So the uncertainty will still be a risk we need to keep an eye on in the second half of the year.
Number 5. In New Zealand, ANZ Research has increased its forecast for June quarter CPI inflation to 0.6% from 0.4% after some solid partial indicators in April and an update to the way that Statistics New Zealand measures vehicle licensing fees. ANZ senior economist Miles Workman says although ANZ's medium-term view is that inflation is still softening towards the middle of the Reserve Bank of New Zealand's 1 to 3% target band, higher consumer inflation expectations in a survey out on Friday were worth noting, although they're still quite small, he says.
I suppose for the Reserve Bank, the real fear for them, the type of risk that keeps them up at night, is when inflation expectations do rise and become unanchored. And while the Q2 data did suggest there is a bit of an increase in inflation expectations going on out there, it wasn't large enough to suggest that they should start worrying that people don't have confidence that they are going to eventually do their job and get inflation down to 2% over the medium term.
Miles Workman there. Now, in today's deep dive interview, ANZ's head of FX research, Mahjabeen Zaman, takes a closer look at Moody's downgrade of the US sovereign credit rating on Friday.
The last time we saw an adjustment in ratings was back in August 2023 when Fitch Ratings downgraded the US home gain AAA to AA+. And before that, back in 2011, where Standard & Poor's downgraded the US similarly. Look, I think the reason or the messaging behind this is really the US fiscal situation. The fiscal profile in the US is much weaker than other AAA rated peers. I mean, just looking at their debt to GDP ratio, it's around 120% of GDP or so. And of course, they have an elevated interest payment on debt outstanding going forward. At the end of the day, the rationale is really around federal debt that has risen sharply due to the continuous fiscal deficit. During the last many years, Fed spending has increased while tax cuts have actually reduced government revenue. So as deficits and debt has grown, interest rates have also gone up. So interest payments on this debt has increased. Now, if the Tax Cuts and Jobs Act, the TCJA, is extended, it will probably add another $4 trillion or so to the fiscal deficit over the next decade. This is likely going to widen fiscal deficits. Currently, it's around 6.5% or so of GDP to a much higher level. And I think this is probably not the best outcome. Similarly, again, as a result of that, yields have also moved higher because they're reflecting some higher term premium, which is really displaying higher inflation volatility and the excess supply of treasuries that will be issued to fund this growing deficit. And we do know that higher yields, especially at the long end, are never really good for the housing market in the US, which is more sensitive to the long end of the curve.
So does this make the US dollar and US treasuries less of a safe haven?
The focus on US growth risks and the US administration's policy agenda may have put the US safe haven status in question. We do think that it is too early to call the recent developments in the US a secular shift from the reserve currency status. We think that the current depreciating trend in the US is really driven as more from a cyclical perspective rather than a structural driver, noting that the US dollar has really been overvalued for several decades. And now the downward shift that we are seeing is really a depreciation or a normalization of its valuation.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, May the 19th. Catch you tomorrow with a final review of the RBA's cash rate decision, which is expected to be a cut of 25 basis points. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.